All right, hello everyone, and welcome to our webinar on Securian SecureCare linked benefit product. I'm Justin Wagner. I'm one of the life sales account managers here at PIPAC. Joining me today to tell you all about this great product is James Romero. He is the regional sales director for linked benefits with Securian. Just as a reminder, I will have everyone muted here for the duration of the webinar. If you have any questions as we go along for James, please post them in the question box, and he'd be happy to answer them after the presentation is over. You can also give me a call after the webinar if you'd like. My direct line, of course, is 319-268-7114. Or otherwise, you could always email me, justin@pipac.com. This webinar will also be recorded and posted on the PIPAC website as well if you'd ever like to go back and listen to it again. At this point, I'm going to turn it over to James, and he's going to tell you all about the SecureCare linked benefit product.
All right, thanks, Justin. Good morning, everybody. Thank you for taking time to be on the call today. As Justin mentioned, I'm James Romero, and I've been working in long-term care now since my 12th year. Been involved with a couple of companies, a lot of good products along the way, and I'm really excited about the SecureCare line of products because it's a brand new option here within the market. It's sort of ahead of the game, and I'll go through what I mean here, the way it's set up and priced. It is built to be ahead of the game where the long-term care market is going. It certainly is going to be a nice option and built with ease to put you in a good position to be able to present to your client. So that's what we'll go through today. But before we do that, just want to address Securian Financial, who we are. So most commonly known as Minnesota Life. Securian Financial is actually the parent company of Minnesota Life, but had several different subsidiaries underneath it. So last year, the company wanted to rebrand everything under the Securian Financial name. So we changed our logo. And so that's why now you're seeing everything shown under the Securian Financial name. But been around a long time, just under the Minnesota Life name for the life insurance products. That's how you know us. So in terms of size, 10th largest insurance company. In terms of life insurance in force, $78 billion in assets under management, and very strong ratings as well. So you can see all our ratings here up at the top, and a 95 Comdex score that's out of 100. So long history, been around about 140 years with solid financials. So no worries there. Mutual company. We've been involved with long-term care since 2005. So we're not brand new to the long-term care space. Now we did enter the asset-based long-term care space with SecureCare in 2017 with the original version, which was a single pay only. And then last year we launched the 2.0 version of SecureCare, which added the multi-pay that we can reach a wider audience. Not everybody does single pay. Some people, it's more helpful with their finances to make payments within their plan. So we added that version last year. And so now we're just making our way and having excellent success with our growth as people become aware that the SecureCare plan exists. So that's what we'll go through. All right, now I mentioned SecureCare is positioned very well where the market is heading for long-term care. So let's talk about what I mean by that. So we're take a look at a couple of charts. So on the left side, the light green, as you can see, those numbers are declining in the light green. Those are sales of traditional long-term care plans. So probably to no one's surprise, while those types of plans still exist and have its fit in the market, overall, those sales have declined. The general consumer, that's not typically the type of plan that works for the mass market today. So you can see those sales have declined. So on that same chart, inversely in the dark green going up each year, those are sales of annuities with a long-term care benefit. Now, that's not what SecureCare is. SecureCare is going to be on the right with the hybrid life plans, and you can see those sales have gone up as well. So the theme here, as you can see with the market over the years, is people prefer more of an asset-based approach, whether it's an annuity or a combination life plan to cover the long-term care. That's been the preference of the market. As you can see, that sales trend continues to go up. So that's what I've been a part of for the last 12 years is the asset-based long-term care market. I'm starting to see the next trend in 2017, but mostly last year in 2018. The next trend I could see happening, a lot more feedback, a lot more conversations about, was an indemnity-style benefit to receive your long-term care benefits. So I want to go over what that is. So there's two types of way on your long-term care plan to receive your benefits when you qualify for long-term care. And one way is reimbursement and the other is cash indemnity. Now, some of you on the call might know what that is, but just to be sure, let's go through what that is. So reimbursement is what's been around for all these years on long-term care policies. What that means in reimbursement, just a quick overview, is that when you qualify for benefits, the way it works is the client typically pays for their long-term care expenses out of pocket and gets a bill from the long-term care provider. That bill is submitted to the insurance carrier, and then they'll reimburse you. So that's what takes place each month. And that type of plan only covers licensed qualified care, so either a licensed facility or a licensed home health care agency. Now that's been the traditional model over the years, but what's changed is the rise of what's called a cash indemnity style benefit. Now the way cash indemnity works on a long-term care policy is once you qualify for benefits, you just receive your monthly benefit as a cash payment each month. There's no maintenance, there's no bills that have to be provided, there's no requirements on the type of care. It does not have to be a licensed caregiver, it does not have to be a licensed facility. The money does not have to be used towards long-term care. It's just a cash payment that you get, and then it's up to you to spend that money accordingly, whether that's for care or their personal expenses. So it's a lot more flexible, it's a lot more easier to utilize the benefits, and a lot easier when it comes to claim time when have to file. So I'm going to elaborate on that a little bit more. But as indemnities become more aware in the community and in the long-term care market, there's been a preference for that ease of the cash indemnity style. Now, reimbursement still, as of today, is the majority type of plan out there. And the reason why that is, and cash indemnity, as I mentioned, is more of a newer style, but gaining significantly in popularity as more people become aware. But also, historically, when you compared long-term care plans and you compared a reimbursement plan versus a cash indemnity plan for a client using the same premium, over the years, you always got higher benefits on the reimbursement plan. So benefits still drive the attractiveness of a policy for the most part. And so if you got more benefits at a reimbursement plan, of course, that's going to lead to more sales for reimbursement. This is where SecureCare comes in. Why join SecureCare? And I think it's on the forefront of being ahead of the market where it's going. SecureCare is the first asset-based long-term care plan that's priced to compete with reimbursement plans, and in some cases will actually hire or offer a higher benefit when compared to reimbursement plans. So found a way to build the policy to compete with reimbursement, so for your same premium dollars can either compete or even sometimes offer higher benefits on a reimbursement plan. So when you can do that and have the cash indemnity story, that's what's made SecureCare so popular, and why we, as more people become aware, where we have been having so much success over the last couple of years. So we'll take you through a little bit more there. But just the ease of qualifying, working with your benefits, receiving benefits, a lot more preferred when it comes to a long-term care policy. All right, so let's take a look at the plan here. So when it comes to long-term care sales, as attractive as SecureCare is, it certainly is going to help you when presenting long-term care to a client because of how easy it is. Still, you can't 100% rely on a product to sell a client on why they should do long-term care. Just want to spend a couple minutes understanding how to position long-term care with clients. So typically if a client does not have a long-term care policy in place, what that means is their entire portfolio of assets are exposed to have to cover a long-term care event. So if a long-term care event comes up, here's what happens. All of a sudden, the long-term care situation causes the need for an additional $60,000, $70,000, $80,000 of income to be withdrawn out of your portfolio to cover these new expenses. So that's one of the biggest myths when you're talking to a client. When you show them the costs or discuss the costs of long-term care, you have to understand these costs and these new expenses don't replace current living expenses. So if you think about a client in their retirement scenario, for an example, they have X amount of income they can take to sustain their portfolio, and they're going to have X amount of expenses that account for that. If all of a sudden a long-term care event comes up, their current expenses remain the same, and the long-term care expenses just add new additional expenses on top of their current expenses, which means they have to withdraw a larger amount of income to offset these new expenses. That quite often is the most important point that's missed in the long-term care conversation. So if people are going to just rely on their own assets, they have to understand that they now have to, in the long-term care event, withdraw an additional $60,000, $70,000, $80,000 on top of their normal income. And majority of people out there, their retirement portfolios cannot sustain that significant of an increase of additional income to be withdrawn. So what happens is, in just a few short years, in 2 to 3 years, by taking that additional amount of income out, you've completely thrown off a retirement income plan that was supposed to last you the rest of life, and it can't do that once all of a sudden you start taking out that additional income. So here's the solution. It's actually pretty easy to hedge against that, and this is where you can show them. By simply repositioning, so if you're seeing the screen here, that little slice that says cash, you can simply reposition a small portion of the portfolio, whether that's in a single premium or by making payments into a plan. And what you'll do now is you'll leverage your dollars to be worth a whole lot more towards care, as well as some other additional benefits. So let's go through the 4 cornerstone benefits that you receive on your long-term care plan. So first and foremost, in the dark green there, by repositioning a portion of your assets into a plan, you're going to get a much higher leveraged amount of money that can go towards paying long-term care expenses. You can leverage your money maybe 5, 6 times the value. Instead of just paying your own money dollar for dollar out of pocket to pay for long-term care expenses, you can get 5, 6 times the value on your dollar in a lot of a long-term care plan. So helps sustain our own assets. But then, of course, there's the big objective still today. The number one objective, people don't move forward to a long-term care plan, is that thought. You know, I understand the value of planning for long-term care, but I still may never need it. And if I never end up needing long-term care, I'm going to feel like I put money with this insurance company and I didn't get anything out of it, so that was not a good value for my funds. No worries. With this type of plan, if they never end up needing long-term care, there will be a death benefit that pays that money back into the family, so that way the money doesn't go away. So you take that big ejection off the table, so you'll have money there leveraged for long-term care expenses, but if you don't need it and pass away, that money will just pay back in to the family. And then there's also the ability to get your money back as a full return of premium. So that's a nice feature to be able to have. You know, people are committing a significant amount of money to these types of plans, and we don't know our future, right? 10 years from now, things might be different with our finances, and we may not be able to keep our money in this plan. So having a full return of premium available is a nice feature that helps people move forward with this plan. That way, if things change down the road, they know they can get that money back. So how does the return of premium works? Just want to go through that with you here. It's pretty straightforward. So if you look at the top left bullet point here, there's different ways to pay for your SecureCare plan. You can do a one-time single pay, or you can do multi-pay over 5, 7, 10, or 15 years. Now the return of premium varies on how you pay for your plan. So we'll start with a single pay. If you do a single pay SecureCare policy, after you complete the 5th policy year, then you have a full return of premium available to you. So you can get your entire premium back after the 5th policy year on a single pay. If you're to do a multi-pay, so 5, 7, 10, or 15 years, the way the return of premium works is after you complete your last payment year, then you'd have a full return of premium. So for example, if you're doing a 10 pay, once you complete your 10th policy year, you'd then have a full return of premium available to get your money back. So pretty easy, pretty straightforward to be able to follow how that works. And then the last option here, this light blue, is a reduced paid up benefit. So that's a nice feature as well. So what that means is this, say your client's doing a 10 pay again, as an example, and they've made 7 payments and their financial situation has changed and they can no longer afford to make those remaining 3 payments. But they don't have to cancel the policy, but they just can't make the remaining payments. Well, a lot of other carriers, if you can't make those remaining payments, you'd have to lapse the policy. What SecureCare allows you to do is called a reduced paid up option. And what that'll do is allow you to do a smaller policy based on what those 7 premium payments in that example would have gotten you. So again, more choices, more flexibility, allow people to feel comfortable moving forward with this plan. If things change in the future, you have different options. There's return of premium. There's a reduced paid up benefit. If you end up passing away, not needing it, there's a death benefit. So a lot of features in place to help people feel comfortable and move forward with the plan. All right, now I do want to show you a quick overview of the SecureCare plan so you can see how attractive this works. Okay, so we should be seeing here a three-step overview here, simplified synopsis here of a SecureCare plan. This would be for a female age 62 if we did a $100,000 premium. So we'll start with the three steps here. This goes through in asset-based long-term care. There's a phrase, live, die, quit. There's the three steps here that can happen on your policy. So we'll go through that. So on the left, if we do a $100,000 single premium, well, if we ever need to quit the plan, just a reminder is, again, after the 5th policy year, you can get a full return of premium. So no worries to the money there. If you, after the 5th policy year, need to quit, get a full $100,000 back. The next in the middle, if you were to pass away without ever needing long-term care, there would be a $110,000 death benefit that would pay tax-free back to the family, so no worries about that money going away. So that's the die part. So we have quit, die, and the last part is live on the right. Live means if you live long enough, eventually, at some point, you're going to need long-term care. And if this person does need long-term care, take a look at what that $100,000 has grown to. At age 80, this has a 3% compound inflation on it. At age 80, the long-term care pool is just over $600,000. So this $100,000 has leveraged 6 times the value. So you're getting 6 to 1. In terms of your $1, you get $6 towards long-term care. So it's a lot more efficient than if you didn't have a plan and you paid for long-term care expenses on your own out of pocket. How strong that is. You can get 6 times value. You get $7,811 per month towards long-term care with the flexibility of cash indemnity, meaning you don't have to go through the reimbursement model. You just get your cash payment. You can have whatever care you choose, whether that's informal care, formal care, combination of both. Use it to pay for living expenses. It's a lot more flexibility. So you can see a very competitive plan with the simplicity and ease with the return of premium, death benefit, and the cash indemnity style. So quick, simple overview. It's a pretty simple plan. So that's one thing that is notable about SecureCare. Of all the different hybrid or linked benefit plans, SecureCare by far is the easiest. And why is it the easiest? Well, a couple things. One, in terms of the benefits, being a cash indemnity, every type of option of how you want to receive your care is available. So think about this. If you don't sell or talk to your clients a lot about long-term care, because maybe you don't know a whole lot about long-term care, and so if your clients ask questions and you feel maybe you can't answer them, so it's not been something you wanted to do a lot just because it's just not something you're an expert at. SecureCare is going to help put you in a great position because there's not a whole lot to know about the ins and outs of the questions the clients would ask. The most common questions client will ask about when you present a long-term care offer to them is about the benefits. Can I use this for the benefits? Can I have this type of care? Can I have care here? The answer is always going to be yes with SecureCare because it's a cash indemnity. There's no requirement. You can have any type of care you want, use the money however you want, because once you qualify from a health standpoint, you just receive your cash payment. So it puts you in an easy position to be able to just answer, because the answer will always be yes, whatever type of care that they ask about. So again, just take a step back. How you qualify to receive your benefits is very simple. You just need your doctor, the policyholder's doctor, confirm they require assistance with 2 of the 6 activities of daily living. And then we just need a plan of care provided, which if you're having a caregiver, a licensed caregiver, they will put the plan of care together for you. If you're having informal care, we will be able, our claims department will be able to do the plan of care for you. There's no charge for that. It's included with your policy here. So it's as easy as that to get your claim going. So it's a simplified process from the claim. And then once you qualify, you start receiving your cash payment and you do whatever you want with it from there. So it goes back to that question, what kind of care will qualify? Everything, because you just get a cash payment, making it very easy for you, puts you in a good position to be able to answer those questions. And then the second part is it's a fully guaranteed plan. There's not a whole lot of ins and outs. Right? So on the plan, your premium's guaranteed, your benefits are guaranteed, the surrender value is guaranteed, everything is very straightforward. So any questions they have about the policy, you will be able to answer. It'll be right there on an illustration for you as well. So very easy plan. And the easier it is, the more comfortable you'll be. And the more he is, the comfortable the client will be because they feel they understand. And that's been a key to SecureCare's success. We made it very easy. Didn't want to add all these different bells and whistles to cause confusion. Really, the only choice you have to figure out is what type of premium mode is going to work best, whether that's a lump sum, 10 pay, 5 pay. That's really what we got to figure out based on the client's finances. And the rest will take care of itself from there. All right, I want to come back to the presentation here. All right, some more information here in the plan. Minimum age is 40, max is 75. Very important to note with the max age of 75, if you're doing a multi-pay, so for example, a 10 pay, you have to be able to make your last payment by age 75. So what that means is you have to be able to begin your policy at a year so that you can make your last payment by age 75. So on a 10 pay, for example, the oldest you could be to start your plan is 65. That way you can make your 10th payment by age 75. So you have to be able to make your last payment by 75. Minimum policy amount on the face amount is $50,000. Maximum is $750,000. Again, that's just the face amount. You have an extension of benefits rider that will provide an additional amount of money beyond that. It's a 90-day elimination period, but want to clarify how that works. The 90 days is, again, it's going to be different. This is a cash indemnity, so it's different than your traditional long-term care policy. So you do not need 90 days of care to go by in order to get past your elimination period and then start receiving benefits. It doesn't work that way. So it's a lot more flexible. We just need 90 days to go by from the moment that you have become a chronically ill individual. So again, the chronically ill is requiring assistance with 2 of the 6 activities of daily living or having severe cognitive impairment. So when you go to file a claim, most people are going to already have satisfied the 2 of 6 activities of daily living well in the past before filing a claim. Right? So we just need verification from your doctor, and we can usually verify in medical records when you've been in this health status of requiring the assistance or severe cognitive impairment. So quite commonly, you're going to file a claim and your elimination period have already begun in the past. And so we'll retroactive start the date based on when we can verify when you've been in this condition. So you can actually, in a lot of cases, end up start getting your benefits right away, as long as we can verify that you've been in this condition for a period longer than 90 days. So it's actually pretty flexible when it comes to the elimination period. There is a residual death benefit. So even if you used up the entire benefit pool for long-term care, there will still be a minimum death benefit, and that minimum amount is the lesser of $10,000 or 10% of the death benefit on your plan. And then let's go through how you can structure the policy. So again, this is a hybrid plan, which means you're going to have a base policy plus an extension rider, which provides the additional coverage. So the base policy is the life policy. Now we can structure this as a 2 or a 3-year benefit from the base policy, but I'll go ahead and let you know it's always a 2-year. We don't ever do the 3-year. There's no need. It's priced and built for the most efficient to be the 2-year. And then for your extension rider, you can do a 2-year extension or 4-year, but again, primarily you're going to do a 4-year extension. That's what the most best value with the price, how it's built. So you're going to do a 2 + 4, which makes it a 6-year plan. So most commonly, we'll do a 6-year plan, most efficient for premium dollar and value. And then next item here is the inflation. So I mentioned SecureCare competes with reimbursement plans and why it's so good from a pricing standpoint. This is a key reason. We're the only carrier with a hybrid plan that has 3 and 5% inflation at simple and compound. So we have 4 different inflation options. Because of those choices of the 4 different inflation options, that allows us to always compete extremely well with pricing with other carriers, because the cost for inflation varies among age, gender, premium mode, couple's discount or not. All that's going to factor in. So when you have more inflation options, it allows you to find the most efficient choice for that particular client, and that allows us to have the best output on your long-term care benefits. Always put SecureCare right in the competition to either compete or even be the best in terms of benefits for your premium dollars here. So let me show you what I mean. So I'm going to refer to an illustration here. Okay, so let's break down. Here's a sample quote of a 60-year-old female with a $100,000 single premium. All right, now the premium is broken down here. So right in this top section, it says premium. So you can see this $100,000 single premium. It's broken down into 4 components here. So you're going to see these different premium dollars here. So for the first premium, the face amount is the life insurance portion. So the premium, so the amount of the $100,000 that goes towards the life insurance is $36,513. And again, I want to reiterate, as you're looking at this, that is a premium amount. This $36,513 is a premium. It's not the actual life insurance death benefit. It's the premium. What we're just looking at right here are premium breakdowns. And then for the access of the plan to access for long-term care of that $100,000 is $15,108. Your extension rider for 4-year extension is $10,741. And then the inflation rider here is $37,635. So that's how the premium is going to be broken down here. So you can see 3% compound inflation, 6-year benefit period, and total of $318,000 pool for long-term care. Initial monthly benefits $4,099. An annual amount $49,196. And then at age 80, the 3% compound has grown the monthly benefit to $7,404. And it's grown the total pool to $574,000, a total pool. Now, this actually is a good policy, right? If you take a look here, $100,000, age 80 gets you roughly $575,000 at $7,400 a month in benefits. That's really good. However, is that the best plan that we could come up with? Also, is this the best plan that's going to stand up to other policies or reimbursement policies for this? If you looked at an example of a 60-year-old female, 100,000 with another carrier that offered reimbursement, could they get higher benefits than what we're looking at here? So we want to make sure we're always putting ourselves in the best position with SecureCare, and I'll show you how we do that. So 3% compound, as we illustrated there, is the most common request. But I want to let you know, we don't always want to go with 3% compound. We want to make sure we're using the best inflation option. Now, here's how we do that. On an illustration, this page in the back here shows you every different option we could go with in terms of benefit duration and different inflation option. And what it's going to do, it's going to highlight what we ran. So here you see highlighted is the 6-year benefit, 3% compound. And if you look to this column to the right here, the age 80 benefit is $7,405. But take a look right below. 5% simple inflation for this client at age 80 would actually get them a higher monthly benefit of $7,917. That's $500 more per month in benefits. And just so you know, a $500 more per month benefit is a significant difference when comparing long-term care policies. So for this client, even though 3% compound is the most common you'll see on long-term care policies, we wouldn't want to go with 3 compound because it's not the best option. For this client, we'd want to go with 5% simple because that gives them a much stronger benefit when it comes to long-term care. It gives them a higher monthly and a larger pool, as you can see, of $605,000 versus the $575,000 that you see with the 3% compound. So that's going to be key. So just one thing, if you're thinking about clients as we're going through this here, and you like to get some quotes, again, quite often the most common go-to is a 3% compound inflation. We don't necessarily want to go to that. Don't worry. When you reach out to PIPAC to get a quote from them, they'll know we've gone through the website when quoting how to make sure we find the most efficient inflation option here. So just want to give you a heads up. If you request 3 compound and they come back with a 5 simple, just want to let you know where that comes up from, because they're always looking to see what's the most efficient inflation option to use. That way you're always in the best position for SecureCare to compete and beat any other plan that's out there. All right, we're going to wrap up here, go back to the PowerPoint, some closing options. All right, you see that bullet point here? It says premium-based structure. That's when we're going through the breakdown of that $100,000. You can see how it's all allocated to different items. What's important to note with that is that also allows for some tax deductions. So for all the premium that does not allocate towards the life insurance component, that's actually premium that's considered healthcare premiums and eligible for tax deduction. So if you work with business owner clients, business owners have some nice benefits to be able to deduct healthcare premiums. So C Corp owners basically can deduct the entire healthcare premium. S Corp LLC can deduct healthcare premiums up to an age-related table. So just so you know, that's going to be a nice, unique feature about SecureCare is you can market to business owner clients as a way to get a hybrid plan, but also get a tax deduction on a portion of the premiums as well. So we have some nice features to be able to help you with that, some marketing materials. So be sure to reach out to PIPAC with any queries on the business owner tax deductions. Nice feature that we can have for you. One last item is a recap here. So again, this is a 7702B long-term care policy, so it's true tax-qualified long-term care. Offers all the benefits that you get out of a long-term care plan, plus informal care, and there's an international benefit as well. You can get your entire policy benefit pool to use on an international basis. You just get half the monthly on an international basis, but it'll still be cash indemnity, but you do get the entire pool of long-term care. All right, one last item here. Here we go, sorry about that. So wanted to just go through the requirements to write a SecureCare policy. So you do have to have your LTCCE requirement for whatever state you're writing the business in. So you do have to have the CE in place, since it is a true long-term care type policy. Also, if you are going to do an application for a client, highly recommend that you send in your appointment paperwork as soon as possible. I know it's very common to send in your appointment request with an insurance carrier at the same time you send in your first app. However, I want to let you know that can actually cause some delays, because it takes us about 2 weeks to get you appointed right now. So we recommend you don't have to have business in order to get appointed. So if you want to get appointed ahead of time, we encourage that. That way it allows us the time to get your appointment all lined up. And then when you do submit an application for a client later on down the road, we won't experience any delays and we'll process right away. Because with that, we actually are turning around policies very quickly. So if you are already appointed, and it's all ready to go, when you do submit an application for business, we actually average 3 weeks from submission of application to policy mail. We're averaging 3 weeks. So running very efficiently, very quickly when your appointment is in place. So again, key. Want to make sure you get appointed, because otherwise that first case is going to take longer than that. It'll take maybe 5 to 6 weeks while we get your appointments all set up. So I'm going to make sure we get appointed. But again, 3 weeks submission to policy mail is the average. That's because primarily we underwrite by a phone interview. So about 80% of applications, the underwriting will just consist of a phone interview. However, about 20% of applications will do some extended underwriting, because as you know, some people will have some health history, and rather than decline them, we'll offer to get their medical records. That way we can do our best. We'll take that next step to get them, put them in the best position to try to get them approved for the policy. But we don't order labs or paramed exams. We'll just primarily just do the phone interview, or for about 20% of apps, we'll then extend to get medical records, do our best to try to get approval for you. There's 2 classes. There's tobacco, non-tobacco, and then there's a couples discount. To qualify for the couples discount, both people do not need to apply. Only one needs to apply. However, for qualify for the couples discount, you have to either be married or in your state recognized civil union, domestic partnership, whatever is recognized by that particular state, has to be in place in order to get the couples discount. But again, both do not need to apply. You can also pre-screen any client. So we're running about a 70% approval rate, so it's really good. And a lot of that is attributed to our pre-screening process. You can call underwriting, or you can send an email to pre-screen any clients, and that way we can eliminate any would-be decline. Helps put us in a better position to move forward and knowing where we stand. All right, so just a quick, simple recap. Again, pretty simple policy when it comes to SecureCare. It is the easiest. Again, there's not a lot of choices. All you have to know as the advisor or the client is what's the best premium option to go with, whether it's a single pay or what amount to do over multiple payments. That's all really you're going to have to decipher. And then when you request a quote with PIPAC, they'll be able to supplement and fill in the correct inflation option. And then after that, as we know, it's going to be a 6-year policy. You'll have the full return of premium. It's all going to be pretty straightforward, pretty easy. We talked about the benefits, how being a cash indemnity simplifies that conversation with you. All those questions the client will have about different types of benefits, the answer will just be yes for you because it's cash indemnity. You just get your payment, you do whatever you want with it. So that makes it easy for yourself, plus easy for the client to understand and easy for the client to use their plan as well, which clients will always appreciate. And then in terms of the way the benefits work, very straightforward. There's a return of premium, there's a death benefit, or you'll have your long-term care benefit pool. All are guaranteed and will be very straightforward on the plan there for you. So simple process, simple policy, simple plan to explain, makes it very easy for you, making long-term care an easy plan to present to your clients there. All right, if you do have any questions as a follow-up, you feel free to reach out to Justin. I'm going to turn that back over to him to wrap us up here, but there's his contact number again. Any quoting, any follow-up questions, if you have any questions on the business owner tax deduction marketing material, feel free to reach out to Justin, and we'll be able to help you with that. Justin, you want to close this out?
Yeah, unless anybody has any questions here they haven't typed up yet, give them a minute to do that. That would be it. Just as a reminder, we do always post these in the next day or so on the website. So if you jumped in a little late or if you missed something and wanted a little recap, you can go to the website and watch this presentation again in its entirety. So that's always a nice feature, especially if you just think of it a couple weeks later. Just want a little refresher as well. I am not seeing any questions here, so I guess we'll wrap it up again. If you have any questions, you can always shoot me an email, justin@pipac.com, or you can call me directly, 319-268-7114. Thanks again for your time, everybody. Thanks, James, and thank you guys all for working with PIPAC. We appreciate it.